There is a phrase, just four simple words, that has been responsible for more financial destruction, more evaporated fortunes, and more shattered dreams than any war, famine, or natural disaster in the history of capital markets. These four words are whispered in bull market frenzies, they are shouted from the rooftops of financial news networks, and they are typed with feverish excitement into the forums and social media feeds where a new generation of investors gathers. The phrase is seductive, it's intoxicating, and it feels, in the moment, like a profound and liberating truth. The phrase is, "This time is different." Warren Buffett, the master of a half-century of compounding, knows that these are not words of liberation. They are the most expensive words in the English language. They are a siren song luring your portfolio onto the rocks of financial ruin. The principle that has served as the bedrock of his entire strategy, the intellectual North Star that has guided him through every speculative bubble and every gut-wrenching market crash, is a profound and unwavering belief in the exact opposite. He operates from the deep conviction that this time is never different. The technology changes, the companies change, the headlines change, the politicians change. But the fundamental drivers of market cycles, the raw, primal emotions of human greed and human fear, are eternally, relentlessly, the same. Getting swept up in a speculative bubble, believing that the old, dusty rules of valuation no longer apply to a revolutionary new technology or a glorious new era. This is the single greatest mistake an investor can make. It is the mistake that turns disciplined wealth management into a reckless casino bet. It is the mistake that turns a carefully constructed plan for financial freedom into a lottery ticket. By embracing Buffett's core insight, by inoculating yourself against this four-word plague, you will undergo a financial transformation. You will develop a deep and unshakable appreciation for the unchanging principles of business and the immutable patterns of human nature. This appreciation will become your anchor of sanity during the inevitable periods of market mania. It will be the fortress wall that protects your capital from the devastating crashes that always follow the euphoria. This is not just a lesson in investing, it is a lesson in reality. It is the final promise that history makes to those who are willing to listen. Let us begin by exploring the absolute core of this philosophy, the engine that drives every boom and every bust, the unchanging nature of human greed and fear. To understand why this time is never different, you must first accept that the human brain, in its reaction to financial opportunity and financial threat, is running on software that hasn't had a major update in thousands of years. We are emotionally hardwired to do the exact wrong thing at the exact wrong time. The story that perfectly illustrates Buffett's early grasp of this concept takes us back not to a famous investment, but to a famous exit. It's the late 1960s, a period that history now remembers as the go-go years. The market was a party. A new breed of gunslinger fund managers were stars, chasing performance with aggressive, speculative bets. Conglomerates, companies that bought up unrelated businesses in a frenzy of debt-fueled acquisition, were the darlings of Wall Street. Names like Litton Industries and Gulf and Western were celebrated as the future of American business. The narrative was powerful. Professional management could optimize anything, and the old rules of sticking to what you know were for dinosaurs. The public was all in. Cocktail parties buzzed with stock tips. Everyone seemed to be getting rich, and getting rich fast. Amidst this euphoria, a 38-year-old Warren Buffett, running his small Buffett partnership out of Omaha, Nebraska, felt a growing sense of unease. He was a product of the Ben Graham School of Value Investing, a discipline built on sober analysis, verifiable earnings power, and a deep margin of safety. He was trying to buy dollars for 50 cents, but in the frenzy of 1968 and early 1969, he couldn't find anything to buy. Everything was priced for perfection, and then some. The expectations baked into stock prices had become completely detached from the underlying business reality. He saw his friends, his neighbors, people with no real investing experience, jumping into the market, chasing stocks they didn't understand, purely because the price was going up. They were infected with a rabid greed, a desperate fear of being left behind. In a letter to his partners in May of 1969, Buffett wrote what must have been a shocking message. He announced he was closing the partnership. He was returning their capital. He was, for all intents and purposes, quitting at the very peak of the party. He wrote, "I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand." Think about the immense psychological pressure he was under. He was telling his investors, the friends and family who had trusted him with their life savings, that he was taking their money out of a roaring bull market. He was forcing them to watch from the sidelines as their neighbors continued to brag about their paper profits. This wasn't just a financial decision. It was a deeply contrarian act of social and professional courage. He wasn't timing the market. He was admitting his own limitations and, more importantly, recognizing the emotional state of the market. He saw that it was no longer a game of business valuation. It had become a game of mass psychology, and the dominant emotion was a blind, infectious greed. The crash came, as it always does. The go-go years screeched to a halt. From its peak in late 1968 to its bottom in mid-1970, the market fell by over 36%. Many of the high-flying speculative stocks and conglomerates that had captured the public's imagination fell by 80% or more. The fortunes made on paper were wiped out. The cocktail party chatter turned to bitter whispers. Warren Buffett, by recognizing that the timeless emotion of greed had reached a fever pitch, had engaged in the ultimate act of capital preservation. He didn't just protect his partners' money, he protected their financial futures by refusing to play a game rigged by human emotion. The power of this anecdote lies in its connection to a deep and unchangeable feature of our minds, our susceptibility to herd behavior and social proof. The underlying psychological principle at play here is one of the most powerful forces in human society. We are social creatures, evolved to survive in tribes. For millennia, conformity was a survival trait. If everyone in your tribe suddenly started running, you didn't stop to analyze the situation, you ran too. The ones who paused to ask why were the ones who got eaten by the saber-toothed tiger. This instinct is now wired into our cerebral cortex. When we see a large group of people doing something, especially something that seems to be making them successful and happy, a powerful signal is sent to our brain. Conform. Do what they are doing. It is the safe and correct path. This is the cognitive bias known as social proof. In a bull market, social proof becomes a deafening roar. Your neighbor buys a stock and doubles his money. Your colleague at work talks about the incredible gains in her tech portfolio. Financial news channels parade a stream of newly minted millionaires who all followed the same strategy. Every signal your brain receives tells you that participating in this stock market bubble is the right thing to do. To resist is to go against the tribe, to risk being the fool who missed out on the easiest riches in history. This fear of being left out, now commonly known as FOMO, is the emotional fuel of every speculative mania. It's a toxic cocktail of greed and anxiety. The greed comes from wanting what others have. The anxiety comes from the fear that the opportunity will vanish before you can get your share. When FOMO takes over, rational analysis goes out the window. The part of your brain responsible for logical, long-term planning, the prefrontal cortex, is hijacked by the more primitive, emotional centers like the amygdala. You are no longer an investor making a calculated decision about risk management. You are a creature responding to a primal herd instinct. Buffett's genius in 1969 was his ability to consciously override this instinct. He built an intellectual framework that served as a firewall against the emotional contagion of the market. While everyone else was looking at the rising prices as confirmation that they were right, Buffett looked at the rising prices and the behavior of the participants and saw it as a symptom of a dangerous psychological illness. He diagnosed the madness of the crowd. This is a critical lesson for any retail investor or entrepreneur navigating today's markets. The tools of social proof are now more powerful than ever. Social media algorithms are designed to amplify herd behavior, creating echo chambers where speculative narratives are repeated until they feel like undeniable truths. The pressure to conform, to join the herd is immense. Developing the skill to step back, to observe the emotional temperature of the market, and to ask, is this rational or is this a stampede, is the first and most crucial step towards true portfolio protection and long-term investing success. So how do we translate this awareness into a practical tool? How can we build our own firewall against the emotional inferno of a market mania? The answer is to create and consistently use an applied mental model that I call the emotional audit checklist. This is not a tool for analyzing a balance sheet. It's a tool for analyzing yourself. It's a series of questions you must force yourself to answer with brutal honesty before making any investment decision, especially when the market is euphoric. Keep this list on your desk, in your phone, or taped to your monitor. When you feel that powerful urge to buy a hot stock that everyone is talking about, you must stop and run through this checklist. Question 1. Am I buying this because I have done a thorough analysis of the underlying business, its competitive advantages, and its long-term earnings power? Or am I buying this primarily because the price has been going up and other people are making money? This is the foundational question. It forces you to differentiate between investing and speculating. Investing is about business analysis. Speculating is about price momentum. Be honest. Did you read the company's last 3 annual reports, or did you just see a chart that looked like a rocket ship? Question 2. Can I write down in one clear paragraph why this company will be earning significantly more money in 10 years than it is today? And what specific, durable advantage will protect those earnings from competitors? If you can't articulate the investment thesis simply, you don't truly understand it. You are likely just latching on to a popular narrative. This is the test of true conviction versus borrowed opinion. Question 3. If I bought this stock today and the stock market closed for the next 5 years, would I be comfortable and confident owning this business? This brilliant thought experiment, adapted from Buffett himself, completely removes the noise of daily price fluctuations. It forces you to think like a business owner, not a stock trader. If the thought of being locked into the investment for 5 years terrifies you, it's a clear sign you are gambling on short-term sentiment, not investing in long-term value. Question 4. Am I feeling a sense of urgency, a fear that if I don't buy right now, I will miss out forever? This is the direct detector for FOMO. Legitimate, wonderful investment opportunities rarely require a split-second decision. Urgency is the salesman of bad ideas. If you feel that anxious, frantic need to get in, it is your amygdala screaming at you, not your prefrontal cortex reasoning with you. Take a mandatory 24-hour cooling-off period. The opportunity, if it's real, will still be there tomorrow. This emotional audit is your personal circuit breaker. It interrupts the feedback loop of greed and social proof. It forces you to switch from your emotional reactive brain to your logical, analytical brain. Consistently applying this mental model is a core discipline of behavioral finance. It's how you build the psychological fortitude required for effective risk management and capital preservation in the face of overwhelming market hysteria. It is your first line of defense against the madness of crowds. To fully appreciate the wisdom of this approach, we must dedicate some time to exploring its opposite. We must walk down the path of the 99%, the path littered with the wreckage of portfolios destroyed by greed and fear. The antithesis of Buffett's deliberate, emotion-free analysis is the frantic chase of hot tips and momentum. This is the world where investment decisions are outsourced to cable news hosts, anonymous social media accounts, and the investor's own brother-in-law. The 99% don't study businesses, they chase narratives. They don't analyze cash flows, they analyze charts. Their strategy is simple and seductive. Buy what's going up and hope it keeps going up. In a bull market, this strategy feels like genius. It works. For a while, a retail investor hears about a new technology, perhaps a biotech company with a miracle drug, or a software company that's changing the world. They don't understand the science or the code, but they see the stock is up 200% in 6 months. Their friends are talking about it. The media is celebrating the visionary founder. They jump in, buying at a price that bears no relationship to the company's actual sales or profits. For a week, maybe a month, the stock continues to rise. They feel brilliant. They check their brokerage account multiple times a day, their dopamine receptors firing with each new tick upward. This is the peak of euphoria, the moment when they are most certain that this time is different. Then, the narrative shifts. The company misses an earnings target. A competitor announces a better product. The broader market gets nervous. The stock begins to fall. The initial reaction is denial. It's just a healthy pullback, they tell themselves. A buying opportunity. But the selling accelerates. The 20% gain turns into a 10% loss. Then a 30% loss. Now the emotion flips from greed to pure, unadulterated fear. The same social proof that convinced them to buy now convinces them to sell. The headlines are negative. The forums are filled with panic. The tribe is running for the exit, and their ancient survival instincts scream, "Sell! Get out now before it goes to zero." They finally capitulate and sell at the bottom, locking in a devastating 50% or 60% loss. They buy at the peak of public excitement and sell at the point of maximum pessimism. This tragic cycle is the lived experience of millions of investors in every market crash in history. We saw it with dot-com stocks in 2000. We saw it with housing in 2007. We saw it recently with meme stocks and speculative cryptocurrencies. The path of the 99% is a path paved with emotional decisions. It is a direct refutation of any sound wealth management principle. It is a guaranteed way to transfer your wealth to the patient, disciplined investors who, like Buffett in 1969, are sitting on the sidelines, waiting for the madness to subside. The financial consequences of this emotional roller coaster are not abstract. They are brutal and quantifiable. The direct financial connection between succumbing to herd behavior and destroying your capital is stark. Let's create a tale of two investors during the dot-com stock market bubble. Investor A gets caught up in the mania. In late 1999, they hear everyone talking about Cisco systems. Cisco was the king of the internet boom, the company making the plumbing for the new economy. The story was perfect. The momentum was undeniable. Investor A, driven by FOMO, invests $100,000 in Cisco stock near its peak price of around $80 per share in March of 2000. For a moment, they feel like a genius. Now consider Investor B. They follow a Buffett-like approach. They see the mania, they feel the pull of greed, but they run their emotional audit checklist. They admit they don't truly understand the complex technology, and they certainly can't justify a valuation that was hundreds of times the company's earnings. They see the widespread public speculation as a massive red flag. So they do nothing. They sit on their $100,000 in cash, perhaps earning a boring 5% in a money market account, feeling foolish as their friends brag about their tech stock winnings. The bubble bursts. By late 2002, Cisco stock has collapsed. It trades for around $10 a share, a fall of nearly 90%. Investor A's $100,000 investment is now worth just over $12,500. They have suffered a catastrophic loss, a permanent impairment of their capital. It will take an almost 700% gain from that point just to get back to where they started. The psychological scar is even deeper. They become terrified of the stock market, convinced it's a rigged game. Meanwhile, Investor B, who practiced capital preservation, still has their $100,000, plus a little bit of interest. They not only sidestep the market crash, but they are now in the perfect position to take advantage of the aftermath. They can now buy the shares of wonderful, durable businesses that have been thrown out with the bathwater at prices that offer a huge margin of safety. The financial difference is not just the $87,500 that Investor A lost. The real difference is the opportunity cost. Investor A is now out of the game, struggling to rebuild. Investor B is on the 50-yard line with the ball in their hands, ready to build serious, long-term wealth. This is the tangible financial power of controlling your emotions. It is not about being smarter than everyone else. It is about being more disciplined. It is the core of risk management, and it is the foundation upon which all lasting financial success is built. Now we move to our second pillar, the intellectual bedrock that supports emotional discipline, the iron law of valuation. The belief that this time is different is almost always used as an excuse to ignore this law. The argument is that some new technology or business model is so revolutionary that traditional methods of valuing a company based on its profits and cash flows are obsolete. This is the most dangerous illusion in finance. The iron law is simple and eternal. A business is worth the present value of the cash it will generate for its owners from now until Judgment Day. That's it. It doesn't matter if the business sells sugar water or artificial intelligence software. The underlying financial physics are the same. A story that brings this principle to life with stunning clarity is Buffett's purchase of the Washington Post Company in 1973. This wasn't a sexy tech company, it was a newspaper, an old media business in a market that was falling in love with glamour stocks. The context is crucial. The year was 1973, and the stock market was in the midst of a brutal bear market. The Nifty 50 era, a period where investors believed you could pay any price for a great growth company like Xerox or Polaroid, was coming to a painful end. These glamour stocks were collapsing, falling 50, 60, even 70%. In this environment of fear and disgust, newspaper stocks were particularly hated. They were seen as stodgy, boring, and low growth. The Washington Post Company, despite being a premier media institution, fresh off its legendary Watergate reporting, was no exception. The market had valued the entire company at about $80 million. Buffett, however, wasn't listening to the market's narrative. He was doing the work. He didn't see an old, dying newspaper. He saw a magnificent business franchise. He saw a company that had a functional monopoly in a major American city. He saw a business with enormous pricing power, a strong brand, and a loyal readership. He did a simple calculation. He asked himself, what would it cost to replicate this business? To build a brand with the same authority, to build a distribution network, to attract the same talent? The answer was billions. It was practically impossible. Yet, here it was, on sale for a mere $80 million. He saw that the company was generating tremendous amounts of cash, but the market, in its emotional funk and its obsession with finding the next big thing, was completely ignoring it. He ignored the story and focused on the numbers. He looked past the sentiment and analyzed the business. Over the course of 1973, Berkshire Hathaway invested about $11 million, acquiring a significant stake in the company. He wasn't trying to catch a falling knife or time the market bottom. He was buying a wonderful business at a price that was, to him, ridiculously cheap. The market thought he was a fool, buying into a dead industry. But Buffett knew the iron law of valuation. He knew that the market's mood would eventually change, but the cash-generating power of the Post's local media monopoly was durable. That $11 million investment would, over the next 3 decades, grow to be worth over $1.5 billion. It became one of the foundational investments that built the Berkshire Hathaway empire. It is the perfect refutation of the new paradigm argument. While the rest of the world was chasing glamour and stories, Buffett was quietly buying durable, cash-producing assets at a discount to their intrinsic value. He let the iron law be his guide, and it led him to one of the greatest investment returns in history. This act of intellectual independence is a cornerstone of any effective, long-term investing strategy. The psychological traps that cause most investors to ignore the iron law of valuation are the overconfidence bias and its close cousin, confirmation bias. These cognitive shortcuts are particularly dangerous during bull markets and technological revolutions. Overconfidence bias is the tendency for people to have an unwarranted faith in their own knowledge and predictive abilities. In a stock market bubble, investors who have made some initial easy money start to believe they are financial geniuses. They mistake luck for skill. They believe they have a unique insight into a new technology or market trend that the old guard, like Buffett, simply doesn't get. This overconfidence leads them to dismiss centuries of financial history and the fundamental laws of business valuation as outdated. They truly believe that, because of their superior understanding of this new era, they can justify paying prices that make no rational sense based on current earnings. This is where confirmation bias kicks in. Once an investor has adopted the belief that this time is different, their brain will actively seek out information that supports this belief and ignore or discredit any information that contradicts it. They will read the enthusiastic articles about the new technology, listen to the bullish television analysts, and participate in online forums where everyone shares their same optimistic view. They create an echo chamber that constantly reinforces their initial, overconfident assessment. If a skeptical analyst points out that the company they love has no profits and is burning through cash at an alarming rate, they won't reevaluate their position. Instead, they will dismiss the analyst as a dinosaur who doesn't understand the new metrics. They will say things like, "You can't value this company on earnings, you have to value it on user growth," or "Profits don't matter right now, all that matters is capturing market share." These are classic bubble-era rationalizations. They are mental tricks to avoid the uncomfortable truth presented by the iron law of valuation. Buffett's purchase of the Washington Post was an exercise in deliberately fighting these biases. He didn't have overconfidence in his ability to predict the future of technology. Instead, he had confidence in his ability to understand a simple, durable business model. He didn't seek out opinions that confirmed a pre-existing bullishness. Instead, he sought out the objective facts: the company's market position, its pricing power, and its cash flow. He let the data guide his decision, not a seductive story. For the modern retail investor, the battle against overconfidence and confirmation bias is relentless. The internet can be a powerful tool for research, but it is also the world's most efficient confirmation bias machine. Whatever you want to believe about an investment, you can find a community of people who will agree with you and tell you you're a genius. The discipline required for successful wealth management and capital preservation is to actively seek out dissenting opinions. It's to find the smartest person who disagrees with your investment thesis and try to understand their argument. This intellectual humility, this constant war against your own biases, is what allows you to adhere to the iron law of valuation when everyone around you is insisting it has been repealed. To put this powerful theory into practice, you need a simple, robust mental model. Let's call it the back-of-the-envelope valuation framework. This isn't a complex financial model that requires a degree in finance. It's a way of thinking that acts as a sanity check against bubble-level valuations. It's designed to anchor your thinking in the reality of business fundamentals. Here is the step-by-step process. Step 1. Find the free cash flow. Don't focus on reported earnings or net income, which can be easily manipulated by accounting tricks. Look for free cash flow, or owner earnings. This is the actual cash the business generates after all expenses and necessary reinvestments are paid for. This is the money that could, theoretically, be sent to you, the owner. You can find this in a company's financial statements, usually the cash flow statement, or on most financial websites. Let's say a company generates $1 billion in free cash flow per year. Step 2. Estimate a reasonable growth rate. This is the hardest but most important part. Be brutally conservative. The market often prices in heroic, long-term growth rates that are almost impossible to achieve. Look at the company's history, its industry, and the overall economy. For a mature, stable company, a growth rate of 3 to 5% might be reasonable. For a younger, faster-growing company, you might pencil in 10% for a few years, but assume it will fade to a more normal rate over time. Never, ever project hypergrowth indefinitely. For our example, let's assume our $1 billion cash flow company can grow at 5% per year for the next 10 years. Step 3. Determine a reasonable purchase price. Here's the simple part. A reasonable, long-term return from the stock market is historically around 8 to 10%. If you want a margin of safety, you should demand a higher potential return from an individual stock. Let's say you want to earn a 10% return on your investment. This means you should be willing to pay a price that gives you a 10% free cash flow yield. In our example, the company is generating $1 billion in cash. To get a 10% yield, you would divide the cash flow by your desired return. $1 billion divided by 0.10 equals $10 billion. This means a reasonable valuation for the entire company, or its market capitalization, would be around $10 billion. Step 4. Compare your estimate to the market price. Now, you go look at the actual market capitalization of the company. If the market is valuing the company at $8 billion, you found a potentially undervalued opportunity. It's selling for less than your conservative estimate. This is what Buffett found with the Washington Post. But if you look and the market is valuing the company at $50 billion, you have an immediate, glaring red flag. The market is demanding that you accept a tiny 2% initial yield, $1 billion in cash flow, $50 billion price, and is pricing in decades of absolutely heroic growth. This is the signature of a stock market bubble. This simple, back-of-the-envelope framework strips away the narrative, the hype, and the emotion. It forces you to ask the only question that matters. As a business owner, how much cash am I getting back relative to the price I am paying? Applying this model diligently will make you immune to the siren song of new metrics. It's the practical application of the iron law of valuation and the ultimate tool for risk management for any serious retail investor or entrepreneur. Now let's venture down the dark path of the 99% once more to see how they reject this iron law. The antithesis of disciplined valuation is the eager embrace of new metrics to justify paying insane prices for assets. This is a recurring theme in every speculative bubble throughout economic history. When prices become so high that they can no longer be justified by traditional measures like profits or cash flows, the market, in its infinite creativity, simply invents new ones. During the dot-com bubble of the late 1990s, the most popular new metric was price to eyeballs. The argument was that for these new internet companies, profits didn't matter. What mattered was attracting users or eyeballs. Analysts and investors would value a company based on how many people visited its website, and then assign a dollar value to each user. This led to absurd situations where a company like GeoCities, which had never earned a dime, was acquired by Yahoo for $3.57 billion in 1999. The valuation was based purely on its web traffic. Of course, it turned out that eyeballs that don't generate cash are, from a business perspective, worthless. The companies valued on this metric went bankrupt in droves. We saw this again in different forms. In the housing bubble of the mid-2000s, the new metric was the belief that housing prices only go up. In the recent crypto mania, valuations were often based on metrics like community size or developer activity, with little to no connection to actual economic output or cash flow. The pattern is always the same. The 99% fall in love with a story, a revolutionary technology, a new way of doing business. They desperately want to believe in the story. When traditional valuation methods show that the price is insane, they don't question the price. They discard the valuation method. They actively seek out and embrace a new, more accommodating metric that validates their emotional desire to buy. This is a catastrophic error in executive decision-making. It is the abandonment of financial discipline in favor of wishful thinking. A business that does not, at some point, generate a sustainable stream of cash for its owners is not a business. It is a hobby or a speculation. Believing that a new technology has somehow repealed this fundamental law of economic gravity is the intellectual foundation of every market crash. It's the self-deception that allows the 99% to pay $1,000 for something that is intrinsically worth $10, all while congratulating themselves on their forward-thinking genius. The financial ramifications of ignoring the iron law of valuation are not just theoretical. They manifest directly and brutally on an investor's statement. Let's make this tangible. Imagine two companies, both with a market capitalization of $30 billion. Company A is Old Guard Manufacturing. It's a boring company that makes widgets. It's been around for 50 years. Last year, it generated $10 billion in revenue and produced a staggering $2.5 billion in real, spendable free cash flow. Based on its $30 billion market cap, it trades at a free cash flow yield of 8.3%, $2.5 billion per $30 billion. It's a cash machine. Company B is Future Tech AI Solutions. It's the hottest stock on the market. Everyone is talking about how its technology will change the world. Last year, it had $100 million in revenue, and because it's in growth mode, it burned through $500 million in cash. Its free cash flow is negative $500 million. The market is also valuing this company at $30 billion. What is the direct financial connection here? What does this mean for an investor? When you buy a share of Old Guard Manufacturing, you are buying a claim on a real, tangible stream of cash. That $2.5 billion in cash flow is real. The company can use it to pay you a dividend, to buy back stock, which increases your ownership percentage, or to reinvest in profitable projects to grow future cash flow. You own a piece of a productive asset. When you buy a share of Future Tech AI Solutions, what are you buying? You are not buying a stream of cash. You are buying a story. You are buying a hope. You are buying a probability that, at some distant point in the future, this company will stop burning cash and start generating it in massive quantities. The entire $30 billion valuation is suspended in the air by nothing more than a collective belief in a future that may or may not materialize. This is not an investment in a business. It is a bet on an outcome. During a market crash, when fear replaces greed, this difference becomes everything. The valuation of Old Guard Manufacturing has an anchor: its cash flow. Its stock price might fall, but there is a floor based on the tangible value of its earnings power. The valuation of Future Tech AI Solutions has no anchor. Once belief in the story wavers, there is nothing to stop the price from falling 90% or 95%. Its valuation was built on faith, and when faith evaporates, the valuation evaporates with it. This is why value investing, at its core, is a strategy of capital preservation. By demanding a reasonable price for a real stream of cash, you are building a financial fortress. By paying a fantastical price for a good story, you are building a house of cards. The iron law of valuation is what separates the fortress from the card house. This brings us to our third fundamental pillar: the power of historical analogs. If the core mistake is believing this time is different, the direct antidote is the deliberate study of how things have been exactly the same, time and time again. Buffett is not just an investor. He is a voracious student of business and economic history. He understands that while the names of the stocks and the technologies change, the patterns of human behavior and market cycles rhyme with an almost eerie consistency. The most powerful example of Buffett using this principle was not a quiet purchase, but a very public warning. In November of 1999, at the absolute zenith of the dot-com mania, Fortune magazine published a landmark article titled "Mr. Buffett on the Stock Market." The article was an adaptation of a speech he gave at a private conference, and it sent shockwaves through the investment world. At a time when Wall Street was cheering the new economy and analysts were predicting the Dow would soon hit 36,000, Buffett laid out a simple, devastatingly logical case for why the stock market was in a massive bubble and why future returns were destined to be terrible. His argument was not based on feelings or complex technical analysis. It was based on a single, powerful historical analog. He presented a chart showing the total market capitalization of all U.S. stocks as a percentage of the country's gross national product, or GNP, a close cousin of GDP. He explained that this ratio is like a Geiger counter for market valuation. Over the long run, it had fluctuated around a central norm. In periods of pessimism, like the late 1970s, it fell to as low as 40%. In periods of past euphoria, like 1929 and 1968, it had peaked, but never for long. In late 1999, as he was writing this article, this ratio was hitting levels never before seen in American history, screaming past all previous peaks. The market's valuation had completely decoupled from the underlying size of the economy that was supposed to support it. He was essentially saying, look, I don't know which of these internet stocks will succeed and which will fail. But I can look at this one chart, which reflects over a century of data, and tell you that as a whole, we have been in this territory before, and it has never, ever, ended well. He was using economic history as his guide. He wasn't predicting the exact day the bubble would pop, but he was stating with near certainty that the party was going to end badly. The reaction from the financial community was largely dismissive. He was called a dinosaur, a man who didn't understand the transformative power of the internet. They said the old ratios didn't apply anymore. They said, of course, this time is different. Just a few months later, in March of 2000, the Nasdaq peaked and the dot-com crash began. Over the next 2.5 years, the tech-heavy index would lose nearly 80% of its value, wiping out trillions of dollars of speculative wealth. Buffett's simple historical analog had proven to be a far more reliable guide than the thousands of highly paid analysts who were cheering the bubble onward. This is a masterclass in portfolio protection. By studying the patterns of the past, he was able to recognize the signature of a mania in the present, allowing him and his followers to sidestep one of the most destructive market crashes in modern history. The psychological principles that prevent most people from using history as a guide are recency bias and the narrative fallacy. These two cognitive errors work together to create a powerful illusion that the present is somehow disconnected from the past. Recency bias is our natural tendency to give greater importance to recent events than to events in the distant past. If the stock market has been going up for the last 5 years, our brains are wired to expect that it will continue to go up. The recent trend feels more real and more relevant than the lessons from a market crash that happened 20 years ago, let alone 100 years ago. This is why, during a long bull market, warnings about a potential stock market bubble fall on deaf ears. The immediate, tangible experience of making money overrides the abstract, historical data about past collapses. People will literally say, "That was then, this is now." They are trapped in a prison of the present, unable to see the larger cyclical patterns that a student of economic history can see clearly. Compounding this is the narrative fallacy, a term coined by Nassim Nicholas Taleb. This is our tendency to be seduced by compelling stories and to create neat, coherent explanations for past events, even if they are just random. In a bubble, a powerful narrative always takes hold. In the 1990s, it was the story of the frictionless internet economy that would bring unending productivity and growth. This story was simple, exciting, and easy to understand. It was far more appealing than Buffett's boring chart of market cap to GNP. The human brain loves a good story far more than it loves a dry set of data. We are wired for narrative. The problem is that these narratives create an illusion of understanding and predictability. When the internet story was in full swing, it felt like the future was clear. Investors weren't just buying stocks, they were participating in a grand historical transformation. This powerful narrative made them feel that the old rules, born of an older, pre-internet world, were no longer applicable. Buffett's approach is a direct assault on both of these biases. The conscious study of economic history is the ultimate cure for recency bias. By immersing yourself in the stories of the South Sea bubble of the 1720s, the railway mania of the 1840s, or the crash of 1929, you force your brain to accept that speculative manias are not a new phenomenon. They are a recurring feature of human economic life. And by focusing on long-term objective data like the market cap to GDP ratio, he systematically rejects the seductive but ultimately hollow narratives of the day. He replaces the story with the statistics, which is a crucial discipline for any investor aiming for long-term success. How can you, as an individual investor, develop this historical perspective? You can create a mental model called the Bubble Recognition Pattern Guide. This is a checklist of the classic, recurring symptoms of a speculative mania that appear time and time again throughout history. By learning to spot these patterns, you can diagnose a bubble in real time, just as Buffett did in 1999. Here are the key signs to look for. Sign 1. Parabolic price moves and insane valuations. This is the most obvious sign. Assets are not just going up, they are going up at an accelerating, almost vertical rate. When you apply a valuation framework like our back-of-the-envelope calculation, the numbers make no sense. Prices are detached from any plausible future reality of the underlying business. Sign 2. Widespread public participation. The market becomes the main topic of conversation at parties, in taxis, and at the gym. People who have never invested before are suddenly quitting their jobs to become day traders. The get-rich-quick ethos is everywhere. When your barber starts giving you stock tips, that is a classic historical sign that the top is near. Sign 3. Media cheerleading and visionary gurus. The financial media shifts from reporting the news to actively cheering the market higher. Skeptics are ridiculed as dinosaurs. A new class of gurus and market wizards emerges, celebrated on magazine covers as geniuses who have figured out the new paradigm. Their pronouncements are treated as gospel. Sign 4. The justification of high prices with new metrics. As we discussed, this is a classic. Whenever you hear the argument that you can't value this on earnings, a massive alarm bell should go off in your head. The invention of new valuation metrics is always and everywhere an attempt to rationalize paying an irrational price. Sign 5. A compelling narrative of a new era. Every bubble is built on a great story. The dawn of the internet, the end of the business cycle, the financial innovation that has eliminated risk. The narrative is always about a fundamental, permanent break from the past. When you hear these stories, your historical senses should tingle. By actively looking for these 5 signs, you are training your brain to see the patterns that most people miss. You can create a simple journal. When you see a news story or an asset that seems frothy, run it through the checklist. Does it have a parabolic chart? Is the public piling in? Is there a guru proclaiming a new era? This conscious, systematic process of pattern recognition is how you internalize the lessons of economic history. It's how you build the intellectual framework that allows you to remain a calm, rational practitioner of value investing while the rest of the world is losing its mind in a speculative frenzy. This is the essence of advanced risk management. Let's examine the antithesis, the path of historical amnesia taken by the 99%. Their core belief is not just that this time is different, but that history is irrelevant. They see the study of the past as a quaint, academic exercise, with no practical application in a world of supercomputers, instant information, and revolutionary technology. They suffer from what could be called chronological snobbery, the inherent assumption that the way we do things now is vastly superior to how things were done in the past, and that the people of the past were somehow more naive or less intelligent than we are today. This mindset was rampant during the dot-com bubble. The argument went something like this. Sure, Buffett's old rules worked in an industrial economy, but the internet is a deflationary force that changes everything. It allows for near-infinite scaling with zero marginal cost. The old models of scarcity and competition don't apply. We are in a new economy, and the lessons of 1929 or 1973 are as relevant as the lessons of the horse and buggy. This is an incredibly seductive argument because it contains a kernel of truth. The internet, old den, talk change many things, but it did not change the iron law of valuation, and it certainly did not change human nature. People in 2000 were just as susceptible to greed and fear as people in 1720 during the South Sea bubble. The technology was just a new stage for the same old human drama to play out. The catastrophic failure of the 99% is their inability to distinguish between the business and the stock. The internet was, and is, a revolutionary technology that has created immense value for society. But this is a completely separate issue from whether a specific internet company's stock is a good investment at a given price. People conflated the two. They thought that because the internet was a great thing, any stock with .com in its name must also be a great investment at any price. This is a profound and common analytical error. The same thing happened during the British railway mania of the 1840s. Railways were a transformative technology. They changed society and created enormous economic value. But the vast majority of investors who poured their money into speculative railway stocks were completely wiped out. The technology was a success, but the investments were a disaster. The path of the 99% is to be mesmerized by the new technology, to fall for the narrative of a new era, and to completely forget the historical lesson that the price you pay for an asset is the ultimate determinant of your return. They forget that even the greatest business in the world can be a terrible investment if you overpay for it. This historical amnesia is a direct route to capital destruction. The financial cost of ignoring historical parallels is staggering. We can quantify the price of the "this time is different" delusion by looking at the total wealth destroyed in the great market crashes. After the dot-com bubble burst in March of 2000, the Nasdaq index, which was the epicenter of the mania, fell from a high of over 5,000 to a low of around 100. This represented a loss of about $5 trillion in market capitalization. Let's pause to comprehend that number. $5 trillion. It's a sum so vast it becomes abstract. It was the evaporated retirement savings, college funds, and home down payments of millions of ordinary people who believed the narrative of the new era. For an individual retail investor who put their $200,000 retirement nest egg into a popular Nasdaq index fund at the peak, their portfolio would have shrunk to about $44,000 just 2.5 years later. This is the direct financial consequence of believing that historical valuation measures no longer mattered. Now compare that to the portfolio of a disciplined student of economic history. That investor, recognizing the 5 signs of a bubble, would have been reducing their exposure to the frothy parts of the market. They would have been selling their overpriced growth stocks and moving their capital into safer assets, perhaps undervalued old economy stocks, high-quality bonds, or simply cash. Their portfolio would not have experienced the exhilarating rise in 1999, but it also would have been completely spared the devastating collapse from 2000 to 2002. Not only did they achieve a far superior outcome in terms of capital preservation, but like Investor B in our earlier example, they were in a position of immense strength when the dust settled. They had the capital and the psychological fortitude to go shopping for bargains amidst the wreckage. This is the ultimate financial advantage conferred by a deep understanding of history. It's not just a defensive tool for portfolio protection. It's an offensive weapon that allows you to exploit the predictable, cyclical foolishness of others. The trillions of dollars of wealth didn't just vanish, they were transferred. They were transferred from the accounts of those who believed this time is different to the accounts of those who knew from their study of the past that it never, ever is. Our fourth pillar builds on this idea of timelessness, moving from market dynamics to the characteristics of an individual business. The pillar is the moat as a timeless defense. In a world of dizzying technological change, Buffett's focus has always been on a concept that is ancient and enduring: the competitive moat. A moat, in business terms, is a durable competitive advantage that protects a company from incursions by rivals, allowing it to earn high returns on its capital for a very long period of time. The belief that this time is different often leads investors to chase companies with exciting new technologies but no real, lasting moat. Buffett does the opposite. He looks for businesses whose protective walls are so strong they can withstand the test of time and technological disruption. A perfect and enduring example of this principle is his landmark investment in the Coca-Cola Company in 1988. By the late 80s, Coke was already a massive, mature company. It wasn't a hot tech stock. It was a simple business selling sugar water, a product that had been around for a century. But Buffett, after a period of deep study, saw something extraordinary. He saw arguably the most powerful moat in the history of business. What was Coke's moat? It wasn't a patent or a secret formula which could be replicated. It was a collection of intangible forces that were almost impossible for a competitor to breach. First, there was the brand. Coca-Cola was not just a drink. It was a global symbol of happiness, refreshment, and American culture. That brand equity, built over 100 years with tens of billions of dollars in advertising, was lodged in the minds of billions of people on the planet. When someone, anywhere in the world, thought soda, the first image that popped into their head was that iconic red and white script. This share of mind was a nearly impenetrable barrier. Second, there was the global distribution network. Coke had built a system of bottlers and distributors that could place a cold bottle of its product within arm's reach of desire for virtually every human being on Earth. Replicating this physical infrastructure would cost a competitor hundreds of billions of dollars and decades of work. The combination of this mental dominance, the brand, and physical dominance, the distribution, created a moat that was as wide and deep as the Pacific Ocean. Buffett realized that this simple, boring business was an economic fortress. Its success wasn't dependent on the next product cycle or a brilliant CEO. It was structural. In the summer of 1988, after a market dip, Berkshire Hathaway began buying Coca-Cola stock aggressively, ultimately investing over $1 billion. This was, at the time, a massive bet. But Buffett was certain. He knew that while fads and technologies would come and go, the simple human desire for a cold, sweet, refreshing drink associated with the world's most powerful brand was a near-permanent feature of human existence. His focus on the timelessness of the moat, rather than the excitement of the moment, led to another one of his legendary home run investments, a core holding that has generated tens of billions of dollars in gains and dividends for Berkshire shareholders. The psychological principle that explains the power of a moat is a combination of the endowment effect and status quo bias. These are subtle but incredibly powerful forces that lock customers into existing habits and relationships with businesses, creating a sticky, profitable environment for the company with the moat. The endowment effect is our tendency to place a higher value on something simply because we own it or are used to it. For a business like Coca-Cola, this means that customers who have been drinking Coke their whole lives feel a sense of ownership and identity with the brand. It's their drink. A competitor can't just offer a slightly better tasting or cheaper alternative to win them over. They would have to overcome the customer's ingrained psychological attachment to the familiar product. This creates enormous pricing power. Coke can raise its prices slightly year after year, and the vast majority of its customers won't even think of switching, because the perceived value of sticking with the real thing is higher than the small monetary savings. Status quo bias is our natural preference for the current state of affairs. Change is cognitively expensive, it requires effort, and introduces uncertainty. Therefore, we have a built-in bias to stick with what we know. This is the psychological engine behind switching costs, one of the most powerful types of business moats. Think about your bank. Is it the absolute best bank with the lowest fees and the highest interest rates? Probably not. But the thought of moving all your direct deposits, your automatic bill payments, and learning a new online banking system is so daunting that you just stick with your current good enough bank. That bank has a moat built on status quo bias. Buffett looks for businesses that benefit from these psychological lock-ins. A company with a powerful brand leverages the endowment effect. A company with high switching costs leverages status quo bias. Another type of moat, the network effect, seen in companies like Visa or Facebook, is essentially social proof and status quo bias operating on a massive scale. Everyone uses Visa because everyone else accepts Visa. To switch to a new payment network would be a colossal coordinated effort, so no one does. Understanding this behavioral science is crucial for entrepreneurs and investors. It allows you to see that a company's true competitive advantage often lies not in its technology, which can be copied, but in its ability to embed itself into the habits and psychology of its customers. This creates a durable, long-term asset that the market often undervalues, especially during periods of fascination with disruptive, new technologies. To apply this principle, we need a mental model for systematically identifying and evaluating these durable advantages. This is the moat identification matrix. It's a framework that forces you to analyze a company not based on its stock chart or its recent news, but on the structural sources of its competitive strength. There are four primary sources of moats you need to look for. First, intangible assets. This category includes things like brands, patents, and regulatory licenses that prevent competitors from offering the same product. When you analyze a company, ask, does this company have a brand that allows it to charge a premium price for a product that is otherwise a commodity? Coca-Cola is the classic example. Tiffany & Company is another. They sell jewelry at a huge markup because of the brand equity in their little blue box. Second, switching costs. This is when it is expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Ask, how much pain would a customer have to endure to leave this company? Your bank is one example. The software that runs a corporation's entire operations, like that sold by Oracle or SAP, is another. The cost and risk of ripping out that deeply embedded software is so high that customers will pay maintenance fees for decades. Third, network effects. This occurs when a product or service becomes more valuable as more people use it. The classic example is a social network or a credit card company. Ask, does this business get stronger as it gets bigger? Visa becomes more valuable to merchants as more customers carry their cards, and more valuable to customers as more merchants accept them. This creates a powerful virtuous cycle that locks out new competitors. Fourth, cost advantages. This is the ability of a company to produce and deliver its products or services at a lower cost than its rivals, allowing it to either make higher profits or undercut competitors on price. This can come from superior processes, proprietary technology, or, most durably, from scale. Ask, does this company have a structural cost advantage that is difficult to replicate? A company like Costco uses its immense purchasing volume to secure lower prices from suppliers than any small retailer could, allowing it to offer unbeatable prices to its members. When you analyze a potential investment, you should systematically run it through this matrix. Does it have a strong moat from one of these four sources? Ideally, does it have multiple sources of moat? A company like Apple, for example, has a powerful brand, intangible asset, and extremely high switching costs for users locked into its ecosystem of hardware and software. The moat identification matrix transforms you from a stock picker into a business analyst. It provides a structured way to think about long-term competitive dynamics, which is the key to identifying the kinds of businesses that can survive and thrive for decades, insulating your portfolio from the creative destruction that wipes out companies with no durable defense. The path of the 99% is, once again, the exact opposite. They are not moat seekers, they are thrill seekers. The antithesis of investing in durable, moated businesses is chasing growth at any price, especially in companies with exciting stories but no discernible competitive advantage. The 99% are drawn to hype. They love investing in companies in hot industries, electric vehicles, genomics, artificial intelligence, without ever stopping to ask the crucial question: what stops another company from doing the exact same thing? They mistake a growth industry for a good investment. The early days of the airline industry are a perfect historical example. Air travel was a revolutionary, high-growth industry, but for decades it was a terrible investment. Why? Because the barriers to entry were relatively low. A new airline could lease some planes, hire some pilots, and start competing on price. There were no powerful brands that commanded loyalty, no switching costs, and no network effects. The industry was brutally competitive, leading to constant price wars and a long string of bankruptcies. Investors who were mesmerized by the growth of air travel lost their shirts. The path of the 99% is littered with investments in companies that possess a first-mover advantage that turns out to be temporary. They invent a new product or service, enjoy a brief period of rapid growth and media acclaim, and their stock soars. But because they have no real moat, competitors quickly flood the market. Think of a company like Groupon. It was a novel idea and grew incredibly fast. Its stock had a hot IPO. But what was its moat? Nothing. The business model was easily replicated, and soon hundreds of daily deal clones appeared, competing away all the profits. The stock collapsed, wiping out the early investors who had mistaken temporary growth for a durable business. Investing in a company without a moat is like trying to build a castle on the beach at low tide. It might look impressive for a little while, but when the tide of competition comes in, it will be washed away. The 99% are constantly building sandcastles, drawn in by the excitement of the construction, only to see their work destroyed again and again. The disciplined value investor, the follower of the Buffett strategy, ignores the temporary beauty of the sandcastle and instead searches for the company that is built on a high, defensible rock, protected by a deep, crocodile-infested moat. The direct financial connection between owning a moated business and long-term portfolio performance is profound and mathematically undeniable. The moat is what allows a company to generate high returns on invested capital for decades, and it is this sustained, high return that fuels the magic of compounding. Let's look at a real-world comparison. Consider Moody's Corporation, the credit rating agency. Moody's has one of the most powerful moats in the world. It's an intangible asset. Its brand and reputation are essential for bond issuers. And a regulatory moat. It's one of only a few agencies whose ratings are recognized. It also benefits from network effects. Issuers need a Moody's rating because investors demand it. Now, let's compare its long-term performance to a broad index of its customers, the financial sector, which is generally more competitive. If you had invested $10,000 in the Financial Select Sector SPDR Fund, XLF, at its inception in late 1998, by early 2024, your investment would have grown to about $58,000. That's a decent return. However, if you had invested that same $10,000 in Moody's stock over the same period, your investment would have grown to over $640,000. That is not a typo. The difference is a factor of more than 10. What accounts for this gargantuan gap in performance? The moat. The financial sector as a whole is competitive. Banks, insurance companies, and asset managers are constantly fighting for market share, which keeps profit margins in check. Moody's, on the other hand, operates in a cozy duopoly with S&P. Its moat allows it to enjoy enormous operating margins, often over 40% year after year. It's a toll booth on the highway of finance. This durable profitability translates directly into shareholder wealth. The company generates floods of cash, which it uses to buy back shares and pay dividends, relentlessly compounding the value of the enterprise. This is the tangible, quantifiable financial power of a moat. It is the secret ingredient that turns a good company into a truly great long-term investment. For entrepreneurs and investors alike, the lesson is clear. The most valuable asset you can build or buy is a sustainable competitive advantage. It is the ultimate defense for your capital and the most powerful engine for its long-term growth. This leads us to our fifth and final pillar, the principle that underpins all the others, capital preservation as the prime directive. This is famously summarized in Buffett's 2 rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This isn't a clever joke. It is the absolute philosophical core of his approach to wealth management. In a speculative bubble, fueled by the belief that this time is different, the entire focus of the market shifts to making money, to maximizing gains, to getting rich quick. Buffett's prime directive forces a complete inversion of this mindset. The first question is not, how much can I make, but how much can I lose? The avoidance of a large, permanent loss is the most important factor in long-term compounding. One of the greatest illustrations of this principle in action was Buffett's conduct during the 2008 global financial crisis. As the world's financial system was teetering on the brink of collapse, Buffett did not panic. Nor did he try to be a hero and call the exact bottom. He did what he always does. He sat patiently and waited for the phone to ring. And ring it did. In September of 2008, with Lehman Brothers bankrupt and the markets in freefall, he received a call from Goldman Sachs, one of the most prestigious investment banks in the world. They were in desperate need of capital to shore up their balance sheet and, more importantly, to get a public vote of confidence from the most respected investor alive. Buffett was presented with a unique opportunity. He wasn't being asked to buy common stock in the open market, which was still incredibly risky. He was being offered a private deal, a chance to structure an investment that put capital preservation first. He negotiated a deal where Berkshire Hathaway would invest $5 billion in Goldman Sachs. But this wasn't common stock. It was perpetual preferred stock that paid a guaranteed 10% dividend per year. That's $500 million in cash, year after year, no matter what the stock price did. On top of that, he received warrants that gave him the right to buy $5 billion worth of Goldman's common stock at a fixed price for the next 5 years. This deal was a masterpiece of capital preservation. The preferred stock was his moat. It was a senior security, meaning he would get his dividend before the common shareholders got anything. The 10% yield provided a massive, immediate return on his capital. The warrants gave him all the upside if Goldman Sachs recovered, but with limited risk. He made a similar deal with General Electric and later with Bank of America. He was not acting as a speculator, trying to guess the bottom. He was acting as a lender of last resort, a capital provider who demanded terms that heavily favored safety and minimized the possibility of a permanent loss. While the rest of the world was consumed by fear, he was calmly and rationally deploying capital, but only on his own terms, with his prime directive, never lose money, as his unwavering guide. This approach not only preserved Berkshire's capital during the worst crash since the Great Depression, but positioned it to make billions in profits on the inevitable recovery. The underlying psychological principle that makes capital preservation so critical is loss aversion. This is one of the most well-documented biases in behavioral finance. Discovered by psychologists Daniel Kahneman and Amos Tversky. Loss aversion describes our tendency to feel the pain of a loss approximately twice as powerfully as we feel the pleasure of an equivalent gain. If you find a $100 bill on the street, you'll feel good. If you lose a $100 bill from your wallet, you'll feel devastated. The emotional impact of the loss is far greater. This psychological wiring has profound implications for investing. It explains why so many investors make the classic mistake of selling at the bottom. The emotional pain of seeing their portfolio decline becomes so unbearable that they capitulate just to make the pain stop, locking in their losses at the worst possible moment. Buffett's 2 rules are a brilliant cognitive tool designed to work with, rather than against, our innate loss aversion. By making never lose money the primary filter for every decision, he frames the entire investment process in terms of risk management, not return chasing. This fundamentally alters your emotional state. Instead of being driven by the greedy desire for gains, you are motivated by the more powerful primal instinct to avoid threats and protect what you have. This defensive crouch is a much more stable and rational emotional posture from which to make financial decisions, especially during periods of market turmoil. The focus on capital preservation forces you to think about the downside of every investment first. What could go wrong? What is the worst-case scenario? How could this investment result in a permanent loss of capital? Only after you have rigorously stress-tested the downside are you allowed to consider the upside. This is the opposite of the typical bubble mentality, where investors are so mesmerized by the potential gains that they completely ignore the potential risks. Loss aversion is a powerful, often destructive force in the minds of most investors. But by consciously adopting a philosophy of capital preservation, you can harness this deep-seated psychological urge and turn it into your greatest strength. It becomes the engine of your discipline, the voice in your head that constantly whispers, "Protect the principal," which is the surest path to long-term investing success and genuine financial freedom. To make this philosophy of capital preservation actionable, you need a practical mental model. That model is the relentless application of what Buffett's mentor Ben Graham called the margin of safety. This is the single most important concept in value investing. The margin of safety is a simple principle. Do not buy an asset for what you think it is worth. Buy it for a significant discount to what you think it is worth. The future is uncertain. Your analysis, no matter how brilliant, could be wrong. The margin of safety is your buffer against errors, bad luck, or the wild swings of the economy. Here is a step-by-step blueprint for applying the margin of safety. Step 1. Calculate the intrinsic value. Using a conservative method like our back-of-the-envelope valuation framework, you must arrive at a reasonable estimate of what the entire business is worth. This is not a precise figure, but a range. Let's say you analyze a stable company and determine its intrinsic value is approximately $100 per share. Step 2. Demand a significant discount. This is where discipline comes in. You do not buy the stock at $100. You do not buy it at $95. You demand a substantial margin of safety to protect you from the unknown. A typical margin of safety might be anywhere from 30% to 50%, depending on the predictability of the business. For our example, let's use a 40% margin of safety. Step 3. Set your buy price. You take the intrinsic value and subtract your margin of safety. $100 per share minus a 40% margin of safety, $40, gives you a target buy price of $60 per share. This is the only price at which you are willing to transact. Step 4. Wait patiently. This is often the hardest part. The stock might be trading at $80, and it might stay there for years. The 99% get impatient and compromise their standards. They'll say, $80 is close enough. The disciplined investor does not. They wait, knowing that the market is manic-depressive and will eventually offer them their price. The opportunity to buy a great business at $60 might come during a general market crash, or because of some bad short-term news that causes a temporary panic in the stock. This patient, disciplined approach is the ultimate risk management tool. By insisting on a large margin of safety, you are building multiple layers of portfolio protection. If your valuation was a bit too optimistic, the margin of safety protects you. If the company experiences an unexpected business setback, the margin of safety protects you. If the overall market falls after you buy, your deep discount provides a cushion, making your investment less volatile and less likely to suffer a large loss. Buffett's deals in 2008 were an extreme example of demanding a margin of safety. He didn't just get a discount, he got preferential terms, guaranteed dividends, and upside potential, creating a margin of safety so large that it was almost impossible for him to lose money. For the retail investor, the blueprint is simpler, but the principle is the same. Value the business, demand a discount, and wait patiently for your price. That is how you operationalize the prime directive of capital preservation. The antithesis to this disciplined patience is the use of leverage and the insatiable desire to get rich quick. The 99%, especially in a bull market, see capital preservation as a cowardly and suboptimal strategy. Why settle for slow and steady returns when you can amplify your gains? They turn to financial leverage, borrowing money to invest, through tools like buying on margin or using complex options contracts. Leverage is the financial equivalent of pouring gasoline on a fire. When things are going well, it magnificently accelerates your profits. A 10% gain in a stock can become a 20% or 30% gain in your portfolio. This feels like magic. It feeds the overconfidence bias and makes the user feel like a financial wizard. But leverage is a double-edged sword. It has no loyalty. It amplifies losses just as mercilessly as it amplifies gains. A 10% drop in the stock can become a 20% or 30% loss in your leveraged portfolio. Worse, with leverage, a significant downturn can lead not just to a loss, but to total ruin. A margin call can force you to sell your positions at the absolute worst time, turning a temporary paper loss into a permanent, catastrophic real one. The history of finance is littered with the corpses of brilliant people who were destroyed by leverage. The most famous example is long-term capital management, LTCM, a hedge fund founded in 1994 by Nobel Prize-winning economists and legendary Wall Street traders. They developed incredibly complex computer models to exploit tiny pricing inefficiencies in the bond market. Their strategy worked for a while. But to make meaningful money from these tiny spreads, they had to use an astonishing amount of leverage. For every $1 of their own capital, they were borrowing more than $25. In 1998, after a Russian debt default caused a global financial panic, their models failed. The market movements were more extreme than their genius models had predicted. The leverage that had juiced their returns now worked in reverse, creating losses so massive they threatened to bring down the entire global financial system. The Federal Reserve had to orchestrate a massive bailout to prevent a complete collapse. The Nobel laureates who thought they had eliminated risk had, in their hubris, made the biggest mistake of all. They had forgotten rule number 1. The path of the 99% is to focus only on the upside, to be seduced by the allure of leverage, and to disregard the possibility of ruin. This is the ultimate rejection of capital preservation. It is a bet that the future will be like the recent past, and it is a bet that, sooner or later, always fails. The direct financial connection between capital preservation and long-term wealth is rooted in the brutal, unforgiving mathematics of loss. This is a concept that most investors fail to appreciate, but it is the key to everything. Let's say you have a $100,000 portfolio. If you suffer a 10% loss, your portfolio drops to $90,000. To get back to your original $100,000, you need to make an 11.1% gain on that $90,000. It's a little harder, but manageable. Now, let's say you suffer a 25% loss. Your $100,000 is now $75,000. To get back to even, you need a 33% gain. The required gain is now significantly larger than the initial loss. Here is where the math gets truly terrifying. If you suffer a 50% loss, your $100,000 portfolio becomes $50,000. To get back to your starting point of $100,000, you now need to achieve a 100% return. You have to double your money just to break even. A single, catastrophic 50% loss can set you back for years, or even decades. The investor who avoids that large loss, even if they earn more modest returns in the bull market, will almost always end up far ahead of the investor who experiences a boom and bust cycle. Let's chart it out. Investor A chases the bubble. Their portfolio goes up 50% in year 1, but then crashes by 40% in year 2. Investor B is a capital preservationist. They earn a boring 8% in year 1 and another 8% in year 2. Who is ahead? Let's do the math. Investor A's $100,000 grows to $150,000, then falls by 40%, a loss of $60,000, leaving them with $90,000. They are down 10% over 2 years. Investor B's $100,000 grows to $108,000 in year 1, and then grows by another 8% to $116,640 in year 2. Investor B, the boring investor, is ahead by over $26,000. This is the tortoise and the hare race of finance. The slow, steady compounding of the capital preservationist will, over the long run, crush the frantic, volatile sprints of the speculator. This simple but profound arithmetic is the ultimate financial justification for Buffett's 2 rules. It demonstrates that the key to building wealth is not about hitting home runs, it's about avoiding strikeouts. Avoiding the big mistake, the catastrophic loss that forces you to start all over again, is the single most important component of any successful long-term wealth management strategy. It is the final, unbreakable promise of capital preservation. You have just been given the intellectual anchor that can protect you from the 4 most expensive words in finance. You now understand that the siren song of "this time is different" is a trap, a recurring delusion fueled by the unchanging human emotions of greed and fear. You've seen how the iron law of valuation acts as a gravitational force, always pulling prices back to the reality of cash flow. You've learned how to use the patterns of economic history as a map to recognize the bubbles of the present. You can now identify the durable competitive moats that separate timeless businesses from temporary fads. And most importantly, you have internalized the prime directive of capital preservation, understanding the brutal mathematics of loss that makes avoiding disaster the true key to long-term success. You have acquired a powerful mental tool, a complete defensive system for your portfolio. But a defensive system is only half of the equation. Warren Buffett's genius is not just in avoiding the manias, it is in his courage and decisiveness to act when others are paralyzed by fear. This defensive mindset you've just mastered is inextricably linked to a powerful offensive strategy. Knowing when to say no is the foundation, but wealth is built by knowing, with conviction, when to say yes. Avoiding a market crash is one thing. Actively taking advantage of one is something else entirely. It requires a different set of triggers, a different kind of courage. The principles of capital preservation tell you what not to do, but what are the specific signals Buffett looks for in the depths of a crash that tell him it's time to deploy billions of dollars? The video that is now appearing on your screen is the other half of this strategic map. It is the bridge from capital preservation to capital deployment. It moves beyond the timeless principles of avoiding foolishness and into the specific, actionable tactics of profiting from it. It is the link that connects the defensive fortress to the offensive siege engine. You have just spent this time building your shield. The next step is to forge your sword. The choice to continue is not just about watching another video. It is a decision to complete your mental arsenal, to evolve from a passive investor who merely survives the cycles into a prepared capital allocator who dominates them. Click and continue your ascent.